Good afternoon, everyone.
Yes.
My name is Kaitav Shah, and I'm a BFSI specialist with Anand Rathi Institutional Equities. Today, we have the pleasure of hosting an MSME finance focused company in its high growth phase, namely UGRO Capital. I welcome the top management of UGRO, Mr. Anuj Pandey, Chief Risk Officer, Mr. Amit Mande, Chief Revenue Officer, Mr. Kishore Lodha, Chief Financial Officer, and Mr. Nirav Shah, Chief Strategy Officer and Head of IR Relations. The format for the calls will be as follows. We will hear brief comments about the result from the management, their respective areas of expertise, post which we can open for Q&A. Handing over the call now to Mr. Kishore Lodha. Over to you, sir.
Good afternoon, everyone. This is Kishore Lodha, CFO of the company. I, on behalf of UGRO Capital, welcome you on the call. Unfortunately, Mr. Nath is not here because of some personal commitments. We have shared the investor presentation yesterday and hope you have gone through the same. Along with me, our Chief Risk Officer, Mr. Anuj Pandey is there. Our Chief Revenue Officer, Mr. Amit Mande is there. Our Chief Strategy Officer, Mr. Nirav Shah is there. And we will be covering the entire portion of the result in our respective areas. As far as this quarter is concerned, the growth momentum continues. Over the previous quarter, quarter-on-quarter growth on AUM has been 20%. We have closed the quarter with 4,375 crore of AUM, which is 126% over the same period last year. We recorded highest disbursement during this quarter, which stood at 1,653 crore, 110% growth over year on year. Overall, loan originated during H1 stood at 3,011 crore, which is 1,123 crore in the previous year in the same period. The yield has improved. Not only the business has grown significantly during the quarter, the yield has also gone up from 16.7% to 17.2%. The yield being increased by two factors. One is that the mix we are changing a little bit where we are going for the higher yielding portfolio, as well as due to increase in the market rate interest rate, we have also increased our lending rate to our customers. Total net income has increased by 87 crore, which is 24% higher compared to the previous quarter. OPEX ratio continues to improve, where while the last quarter it was close to 73%, now it has come down to 62%. On PBT, we have closed the quarter at 17.6 crore, whereas last quarter we closed around 10 crore, so there is almost 70% growth quarter on quarter as far as PBT is concerned. However, the PAT has gone down from 7 crore to 5 crore. It is largely because of we have taken the reversal of deferred tax asset of 7.19 crore during the quarter. So had that not been there, the PAT would have been 70% higher compared to the previous quarter. During the quarter, we have added 6 more lenders in our lending book. So now there are more than 65 lenders. Which is quite diverse. So almost every lender you can name is there in our borrowing book now. Some of the impact funds we have added during the quarter, some of the large NBFCs and banks we have added during the quarter. Overall, though the interest rate scenario is looking difficult, overall repo rates have gone up from 4% to 5.9% in the market, but our rates have gone up by only 20 basis points during this first half. It is because of the efficiency that we are bringing in and with the seasoning with the lenders that is coming in. Our rates have remained more or less flattish during the quarter. So, as we discussed in our earlier calls, that we will be doing more of co-lending, increasing our exposure in co-lending and co-origination book, and we have continued with that strategy where co-origination and co-op book has increased from 21% to 29%, and our endeavor would be to take it up to 35% till March 2023. Which will add to the ROAs and ROEs as we have deliberated in our earlier discussions. Now I will hand over to our colleague, Mr. Anuj Mande, to talk about the asset qualities and the collection for the quarter and for the half year ended 30 September.
Thank you, Kishore. Good evening, everyone. Before I take you through the asset quality for the first half of the year, I would like to recap our underwriting approach and model. So we use what we call GRO Score 2.0, which is a statistical based underwriting template which has been developed in-house. And the idea was to look at the chosen sectors of ours, which are 9 of them, and develop models for customers basis their banking behavior and repayment behavior. We have been using this since our inception. We are currently on the version 2 of that score. When we started, we were only using the repayment based scoring. And this has, we have seen tremendous efficiencies because of that, both in terms of a very predictable portfolio performance and giving a very good turnaround time as far as underwriting decisions are concerned. Our approach on a scientific templated underwriting model is well underway, and we are quite happy with the progress. In fact, now we are upgrading our GRO Score template to the version 3, where the plan is to also include the GST data in using and predicting the repayment behavior. And in future, we would like to forecast the cash flows by customer for each of the sectors which we have chosen, and also get some estimates on the eligibility itself from this. So overall, from the robustness and from the results of scorecard perspective, we are quite happy with the progress. Now coming to the portfolio performance, the gross NPA at the end of September 30th is a little less than 1.7%, quite stable. We were at 1.7% in previous quarter as well. The net NPA stands at around 1.2%. Our overall approach on the portfolio mix has been quite clear from the start. We would like approximately 70% of the portfolio to always be secured, either by collateral or by some kind of credit enhancement. So we continue to do that. The portfolio at the end of September 30th is also in the same ratio, 70:30. Some of investors and analysts keep asking us about the portfolio performance in the light of less seasoning of the book. And I would like to touch upon this topic, and this is something which we closely monitor. The approach which we have adopted, because the true test actually will come post the portfolio gets seasoned for a few more years. But now with the scientific tools available to us, we keep tracking the early portfolio indicators. Also, if you recall, we had started, when we had started, our focus was to garner more of secured assets at a relatively lower yields, which historically have proven and given lower NPAs. So the philosophy is to build up slowly, to lend to customers who have very good repayment track record. We don't lend to new to credit, and keep tracking the early portfolio indicators. So far, we have seen that all of them are tracking quite well. We also every quarter do a proof of concept of our GRO Score, and in that we widen the net, and we keep also assessing the customers who were scored by us but were not given a loan for a variety of other reasons. But we keep tracking their portfolio performance for their repayment behavior in other loans, and we find that indeed the risk ranking which is coming out of our internal GRO Score is stacking up. On the collection efficiencies front, the collections efficiencies on an overall portfolio level remain stable. They are at around 94%, and this has been the number for last 2-3 quarters. In fact, our estimates are that they will steadily improve with overall improvement in the macroeconomy. On the bounce rate fronts also, we have seen a steady decline in bounce rates. Now at a overall portfolio level, they are at around 17%. A little bit on the restructured book in the portfolio. When we started at the end of pandemic 2, the total restructured book was around 7% of the portfolio. Now it has got reduced to 2.6%. So in absolute terms, about 113 crores of the portfolio which was restructured is on books. About 95% of those restructured customers, the repayment period has started. And now we have a very good fix and hang on how the portfolio under restructuring is behaving. And we are quite happy with that progress as well. In terms of overall provisioning, our provision coverage ratio for stage 3 has improved by more than 200 basis points, and now it is around 30%. Our overall stage 1 contribution has seen a lot of improvement, and it has gone up now to 96.4% from 94.6% in last quarter. So on an average and whole, this has been quite a good quarter as far as portfolio performance is concerned. Now I'll hand over to Mr. Amit for his views on business.
So a quick, in fact, wrap up of whatever Kishore and Anuj spoke. Kishore spoke about our achievements on disbursements and AUM. Anuj further spoke on the health of the portfolio. I would like to only add a couple of points. In fact, wanted to add that we have now very strong inroads in every type of distribution, which essentially means that strong inroads in the intermediary-led, the direct distribution, the ecosystem-led distribution, and the fintech-led digital origination. What is important to note is that all our products in our underwriting framework is now acceptable in all the banks on the co-lending piece, which means now we have the confidence to sweat out our infrastructure and people to build, that we've built over the last 2 years. What we are very excited about is that we've built a very robust distribution with a granular portfolio, and the average ticket size keeps going down from the current 16.5 lakh rupees. The mix of the unsecured, secured is also remains also very healthy as Anuj spoke. So we will continue to build efficiencies to fuel our growth trajectory on the disbursements and the AUM to touch the 7,000 crore AUM by end of this financial year, and across all parameters as the guidance that we've provided in our presentation. So having said that, Neerav, you want to do the closing comment?
No, I think, yeah. So, no, thanks, Amit. So, most of it has been covered by my dear colleagues, Kishore, Anuj, and Amit. What is important for all of us is to note that we were very bold in terms of releasing what we will achieve in FY23 going towards FY25. When we did that, a lot of questions had come to us saying it is too futuristic a number for you guys to kind of deliver, and a lot of the sell side and buy side will actually tie in and say that you have not been able to achieve, or try and compare yourself with your achievements. We were actually very bold that time, but what we are now doing is we have spent a very good amount of time ensuring that each of the line items, when it comes to yields, when it comes to interest costs, when it comes to employee expenses, etc., we are tracking it very granularly on a month-on-month basis, right? And we believe now that what we have set out, we are there to achieve it. I think that is the only thing I wanted to convey to the community, that yes, it is difficult for us to kind of achieve the bold numbers that we have given out, but I think we are very well on track to achieve those numbers. I think with that, I will hand it over to Kaitav, and Kaitav may want to open the floor for questions.
Thank you, Neerav. We can open the floor for questions. I would like to request the participants to raise your hands and to introduce yourself before taking a question. Thank you so much.
I think there's a question from Anil Tulsiram. Maybe Anil, please go ahead and ask the question.
Yeah, thanks for taking my question. This is Anil Tulsiram from Contrarian Value Edge. My first question is on the capital raise. So so I want to understand how important it's for you to raise the funds in the next 12 to 18 months. And in the unfortunate case that you're not able to raise the funds, then what is the maximum leverage credit rating agencies and lenders will allow us?
Sure. So we had during a last call, we had given a guidance that we would be doing an equity fundraising process, and by end of this financial year, and that process is something that is currently on. Even in case where we are still not able to achieve or being able to raise that equity, we will still believe that with our co-lending approach, we should be good enough for the next 12 to 18 months time frame and still be able to achieve the same numbers. With respect to your question on the leverage, we have always believed that we would cap our leverage at 4 times 4 times debt to equity ratio, and there is still a long way from the current 2.85x leverage that we have at this point in time.
To add on what my colleague had said, that if you look at our capital structure, as of now, we are entirely relying on equity capital, whereas we have the option to raise tier 2 capital up to 50% of the tier 1 capital which we have. So that option we have not explored till now, but that option is also available if the need arises.
On leverage, I have a question. There are many microfinance companies which give the guidance that they are comfortable with 5 times leverage. Being unsecured, they are comfortable with 5 times, and the credit rating agencies are comfortable. Then why do we want to restrict ourselves only 4 times? Means what is the rationale behind it?
So I think, Anil, there is no real as such rationale. I think we just wanted to make sure that we are able to weather any kind of a storm that comes in future. So by restricting us, so there is no hard coded 4x debt to equity ratio that we are saying. What we are saying is that once we are achieved that or we are close to that number, then we should be looking at other avenues of fundraising. It could be equity, as Kishore said, it could be tier 2 debt, etc., etc. While with our vintage, we are pretty much sure that we can still reach 5.5 times debt to equity ratio. But just to be within our limits of and to have a very clear visibility, we are saying we'll preferably not want to go beyond 4x at this point in time. That also leaves something what we call as a confidence capital on table for the other large debt participants like public sector banks, etc., would become very comfortable when it is sub 4x leverage.
Okay. Sir, and my next question is on the account aggregator. I think it is going to get implemented from the early next year. And once it gets implemented, what we are trying to do with the growth 3, that any bank will be able to do it, means collecting the account statements and the GST data. So in what way it will be difficult for them to replicate what we are doing, or means how the underwriting is much more beyond just this bank statement and GST? That is what basically I want to understand.
So I take this up. In fact, account aggregation and the account aggregated model is already live. And there are about 10 banks which are already live. And what it does is basically on one consent of the customer, it allows the financier to fetch all his bank accounts. Eventually, all his financial assets will get added in this network. That is the broad plan. Now, to your question of whether this will truly democratize the banking data and hence how we are different. If I understood you correctly, to tell you, the banking data is still available to all, including the banks themselves. The point is whether you are able to apply them in a smart way, in a statistical model, to your chosen target segment. That is where proprietary work and insight-based work comes upon. Now today, our underwriting is primarily based on GST, banking and repayment. Now, these are things which are not available to all for last 5 years, but still, basis the application of a machine learning algorithm on our chosen target segment, we have been evolving the underwriting model, and that is something which takes time. And hence, whosoever chooses to do that, of course, can do for their own chosen target segment. But in that journey, we think we would be always 2 to 3 years ahead.
And sir, one last question is on the collection efficiency of the restructured assets. That's it. With that, I am done.
So currently, about 66% of the restructured assets is current, and the rest are in delinquencies. About 25% of total restructured assets have actually flown into NPA, which has already got reported in our total NPA figure. We have now got a sense of what more can come in, and it seems that maybe about 3 to 4% more from restructured asset, we estimate more NPAs to come in.
That's it, sir. I'm done.
Thank you, Anil. I think Mr. Wayne DeMello can go next.
Hi. Yes, so congrats on a good set of numbers. My first question was on the co-lending side, specifically on our Grow Extreme platform. So we have partners, fintech NBFCs that we've partnered with, who also have their own platforms. Like you have Lending Cart, which has their Together platform. You have UB with their co-lend platform. So my question on Grow Extreme is, you've said that you want to grow it to be the biggest platform for co-lending in India, where even the smallest of the NBFCs can get in touch with the largest of banks. So my question is, one, what do you see as the USP of our platform when compared to the other platforms that exist? And what are your goals? How do you see the progress, and what's the timeline on that? That's the first question.
Okay, so overall, the difference is in the concept, because we are a large lender ourselves. So when a balance sheet provider makes a platform which can be integrated with other lenders and other partners, then the insight which it brings, for example, we have a proprietary growth score which is already developed and now is getting proved quarter on quarter on our chosen MSME segment. Now, if a partner wants to use that for their data, that would be available to us. But our approach has always been complementing and not competing. So, for example, we are integrating with the UBs of the world and other such platforms. Typically, what happens is in a PSU bank, especially, it is very difficult for them to integrate with many platforms, and it might so happen that one of these platforms get integrated first. Our approach has been to either integrate directly or integrate via these platforms, so that overall we are able to serve the needs of the ecosystem.
Okay, that makes sense.
One more thing I would add is use growth score being.
Yeah.
So one more thing is that the ability of the smaller NBFCs, not only the smaller NBFCs, also the larger banks and NBFCs to use the proprietary growth score, which is the real value add. So one is of course the platform. Two is the IP, intellectual property value add of the growth score for each of these partners to access and evaluate their portfolios. And third, of course, is the ability to be a lender on the smaller NBFC. So it's a little different than with a platform like a UB, which is only a platform that connects multiple partners.
Yeah, understood. Thanks for the reply. So yeah, on co-lending again, by 2025, we've guided for 50% of our book to be off book. Of that, I think you said around 23% will be through co-lending, right?
That is correct.
Yeah. So so what are your thoughts on increasing that percentage? Because it's obviously better for us on the ROEs and on those metrics, and we have peers that are already doing up to 90% off book. So do you have any thoughts on are you flexible with taking it up from the 50% that you've guided for?
So at this point of time, the guidance is 50%, and there is the opportunity to further increase it to higher percentages. There are two things that the way we look at it. A, just being a platform has to be acceptable, because then we are just 10%, we are just a platform. And so whether the people whom we are co-lending with, they don't find our skin in the game. And so that acceptance has to yet be improved. So the opportunity still rests, but we don't just want to be a passive platform and a lender. We want to have our skin in the game. So at this point of time, we envisage 50. If the opportunity permits, we could further take it up as time goes by. At the current point in time, we anyways on month are off booking 50% of our disbursement. You would have seen our off book AUM now at 29% of the total AUM, which has moved from 21% in last quarter. So it's moving very rapidly. So like you said, there is opportunity, but we would like to keep skin in the game. We would like to give that confidence to our co-lenders. And so 50% is what we believe is the right number to reach by 2025.
Okay, thank you. And one last question is just for the sake of investors, like how do you guys define collection efficiency? So we are at 94%. So what comprises the rest of the 6%?
So we define collection efficiency by current demand divided by current dues, current collection divided by current demand. Typically, in other financial services industry, a lot of people give collection efficiency by dividing the total collection by current due. If we do that, our collection efficiency would be closer to 99%. So this rest 6% is what flows into what we call buckets. The first bucket is called bucket X. Typically in that bucket X, our resolution rates are around 97 to 98%.
Okay, that's all from my side. Thank you for the detailed replies and all the best for the future.
If there are any questions, please raise your hands. In the meantime, we have a question that has come up on the chat. In terms of portfolio concentration, our top 3 states are Tamil Nadu, Gujarat, and Karnataka. In which regions are we focused primarily? Is it larger cities or the tier 2 and 3 markets? Over to management.
So we have 2 distinct branch-led channels. One is what we call prime channels, which is now in the top 25 locations spread across 9 states. And these typically are locations where the concentration of our targeted sectors is higher. For our micro enterprises distribution, we had chosen 5 states to invest in. So today we have about 75 branches in Tamil Nadu, Telangana, Karnataka, Rajasthan, and Gujarat. We chose these 5 states basis a thorough statistical analysis by pin codes across the country for our kind of ticket sizes, the health of micro enterprises, and the portfolio performance. And we found that these 5 states were cut above the rest. So our distribution strategy in micro going forward also would be focused on these 5 states.
Sure, thank you. Sir, if I may slip in a couple of questions. Could you talk about more on the competition in the market that you're seeing, given that we're seeing banks also growing in the PL space, in the lab space, small ticket size loans? How are you seeing the competition shaping in?
So 2 ways to look at it. One, the competition has always been there. The MSME segment has always been a hot segment where the banks always wanted to build their portfolios in. There is not only the banks or the institutional push, but there is a larger strategic push from the government itself towards the NBFC. So the competition is there in the segment. On one side, there is competition and banks and liquidity. On the other side, people talk about the credit gap that is there in the MSME segment. Now, between these two things, one would have realized that delivery of credit to the MSME is an extremely difficult subject that people thought it was. And a large focus has always been on the consumer segment, like the personal loans or the vehicle loans, etc. What we've been able to do is really focus by sector and by geographies into the MSME segment. That our dedicated and committed focus has also led us to build a risk model that is unique and can scale up. So in that sense, we have a better risk and underwriting model, and that is why our turnaround times to the customers and ability to assess and understand customers is better. And so while we appreciate and we really respect the competition that is there in the market, we believe that we have a unique proposition because of which we will stay ahead of the competition. In the segment that we are, whether it is the micro enterprises segment or the machinery finance segment, or for that matter, the business loan secured and unsecured, our proposition is to work on data and technology and give fast turnaround times, assess the customer right, and that has helped us to. That has been the real pillar of our growth in last 3 quarters.
Sure, thank you. Next question is from Mr. Chinmay Bhargava.
Hi all, congrats on an excellent quarter. I just have a simple question today on the deferred tax that we had to pay out. I just wanted to ask why we chose to recognize it this quarter, whether we expect to recover any of the amount, and whether there's anything more that needs to be set off in the future.
So the reason of taking it in this quarter is that as per the income tax rules, after 8 years it lapses. So that period is over. So that is how it has to be taken into this quarter. So this is by law where we have to take 7.19 crore as hit in this quarter. However, there will be further impact on future. It is difficult to tell at this moment because it will depend upon our future profitability, whether we will be able to absorb the carry forward losses or not. Depending upon that, further hit may or may not come.
Sure, but I just meant in terms of the structure we inherited, right? Like this happened 8 years ago. I just wanted to ask whether there's anything else from, pre FY19 that needs to be set off.
No, so as per this entire loss came because of merger, which happened in 2029, and this where we have recognized the deferred tax asset. And once the 8-year period has elapsed for this particular segment, we had to reverse it. There is another set of carry forward loss which is there, and whether we will be able to utilize it in future or not, or whether we will have to reverse it, it will depend upon the profitability as we move forward.
Okay, thank you. All the best.
Mr. Anil Tulsiram.
Yeah, sir, we started some micro branches, I think some 12 months or 18 months back. So can you elaborate upon the journey and how the progress has been? What has been our experience, credit cost, successes, failures, whatever, how it is shaping up basically micro branches?
So it's been a extremely good question, and I appreciate this question because micro enterprises branches is going to be a focus area for us and area of growth. We started about 75 branches in Q3 and 25 branches in Q1, Q2, and then reached about 75 branches in Q3 and Q4. The learning curve has been there. We always believe that there would be a learning curve, and so this year we decided to not expand and see how these branches become profitable so that it really powers our growth going forward. What we've seen is today as we speak, from the 75 branches that we have, 31 branches have already broken even, and we will see the entire set of 75 branches breaking even by end of this year, which means that the break-even period of between 12 to 15 months that we expected, and the model is working. Once all these branches have, nearly all branches have broken even, is when we set up to expand our distribution to 50 more branches in the first 2 quarters of the next year. On the credit losses, Anuj, you want to take the credit losses?
Yeah. So overall, we have about a little over 12 to 15 months of experience of the book, and the gross NPAs there in our micro book are little less than 1%. So from the underwriting perspective and choosing of locations perspective and the target segment, we are quite happy with the progress.
To add to what I was just given, that the portfolio and the target segment is right and the portfolio is behaving well, would want you to also note that why is this a focus area is because this is a secured product that we do on the micro enterprise branches. B, the yields are in the range of 20 to 22%, and given our roadmap of 250 branches in the next 3 years, this is going to be a large portion of our growth strategy.
And sir, just one thing, I think micro branches does only unsecured loans, right? Unsecured loans of 5 lakhs and not secured loans. Is my understanding right?
In fact, it is not. Micro secured branches does primarily does secured micro loans. So our loan ticket size, secured ticket sizes, average ticket size ranges between the loans are between 1 lakh to 25 lakh. Our average ticket sizes are at 7.5 lakh at this point in time, and 85% of the loans that we originate are secured loans from the micro secured branches, micro enterprises branches.
Okay. Sir, and just one clarification, the loans which we do through our fintech partnership, when we represent it as a presentation, we show it as under secured loans or under unsecured loans. How do we represent that?
So they are secured by FLDG. So in our representation, we show it under secured loans.
Okay. Thank you, sir. That's it. Thank you.
Mr. Jaydev Trivedi.
Hello, am I audible?
Yes, go ahead.
Thank you for the opportunity. Congratulations to the management for the impressive set of numbers. What I understand from the shared PPT is that we are targeting AUM of around 7,000 crore and loan book of 4,500 crore, right, by the end of FY23. So for that, currently we have CAR of 28% and DBI of around 2.9. So do you think in near future we are going to have some capital infusion to support the growth? And
Yes, we will have.
So Nirav had already addressed this. So we are in process of an equity raise, but strictly from calculation purposes, we don't need that. We will be able to meet our AUM targets both on book and off book without the equity raise as well. But in our plans, we had planned to raise equity in this financial year, and we are working on it.
And sir, one more follow-up on the same topic. We have some of the very known PE investors on our investor list, but as of now, we haven't seen any follow-up round from them. So is it expected to come again, or it's, if you can disclose anything on that, if it is possible?
So I mean, Jaydev, basically the idea of I mean, while a couple of our investors already own about 21% in the company, and they have been supporting us all throughout. We would want to have investors now who are more granular in terms of their ticket size of investments. Okay. either it could be them or it could be somebody who is coming in with a fresh capital now and has a horizon of staying on for the next 7 to 10 years, as a shareholder. And hence,
Right, sir.
we believe that, yeah, so then we would want the new set of investors to be either somebody who can stay with us for 7, 10 years, or more like a capital market investors, right, who are more granular in nature. But if needed, then they will definitely support us.
Understood. And sir, one more thing. They have been with us like for a few years now, and is it possible they are looking for any exit, any of them, in due to the tenure of their fund or anything?
So see, by its very nature, every private equity fund has a fund life, right?
Exactly.
But the fact is, out of our 4 years of operations, 2 years of it has been COVID, and most of the private equity funds actually do understand that and support us on that front. There is currently no exit pressure from any of the funds at this point in time, but they will eventually look at an exit over the next 2 to 4 year time frame. One of the private equity fund, PAG, has brought down its shareholding from to about 9% from their original about 19%. They have been able to get the liquidity directly from the market itself. But having said that, for the existing 9%, 9% that they have, again there is no pressure on them to kind of sell because most of the capital has been returned back, right? So there is no current imminent pressure from any of the private equity funds.
Right, sir. And is it Samena Capital has increased their holding? And is it so from the current open market or anything else? If it is the case.
No, that is actually not the case. Amina has been an original investor in the company since the time we raised our money in 2018.
Yeah, I meant if they
They haven't
increase
really
their holding.
increased or decreased. They haven't increased or decreased their holding. They have been stable.
Okay, sir. Okay. Thank you for the answers, sir. Again, congratulations for the numbers.
Mr. Nikhil
Thank you.
Agarwal. I think he's dropped out of the queue. Mr. Sanjay Kumar.
Hello.
Yes, Mr. Sanjay. Please introduce yourself and go ahead.
This is Sanjay from PMS. My first question is on collection efficiency. It's around 93-94%, which means on average 6% of customers not paying. So our slippage ratio or credit cost ratio should be close to this number, but that's not the case. So I know CE is not a rolling number, as in customer who didn't pay in August would have paid in September and would have dropped off the bucket. But there is this huge gap. So, and if I see your 30-day past due, 30 DPD is around 5-6%, and then there is a drop off in the 90-day past due to 1 to 2%. So, can you explain this client behavior? Are they always, they pass their due for a few days, and then when they get their cash, they pay it back?
Okay. Two things. One, the understanding of how the flow rates works. So typically, whatever is bounced will move into DPDs or what we call collection buckets. Typically, there are 4 collection buckets. Between 0 to 30 days past due, 30 to 60, 60 to 90, and 90 and beyond, which basically means whether you have 1 EMI due, 2 EMIs due, 3 EMIs due, or more EMIs than 3 which are due. For our kind of target segment, typically in the first bucket, the resolution rates are closer to 95, 96, 97%. Because this is a function of the nature of the target segment. This is an SME. He may not have the money on the due date, but he is fine paying the amount in that calendar month. Then if there is more than one EMI due, then typically the resolution rates are between 70 to 80%. If there are more than two EMIs due, the resolution rates they will fall obviously, and it is around 50 to 60%. And then the case becomes NPA, and then there is a recovery rate depending on the product, which is about 20 to 25%. So when you multiply all of them together, you get a number which is called product of flows. That is the number which gives an indication of how much of your current asset is likely to become NPA in the subsequent 3 months. That number for us is between 0.1 to 0.15%. And this is a number we keep tracking regularly. The number which you quoted for 30 plus and 90 plus, I think we're a little different. Our 30 plus number end of September is 3.5%. So there are 3.5% of the portfolio where the customers have not paid more than one EMI.
Got it, sir. So if you could, more of a request, so if you could give the 30 DP day of as of September 30, because you've given it for the recent logins.
Mr. Sanjay Kumar, you'll have to mute your line.
There was a lot of disturbance. Can you come again?
30 plus number September ending.
Okay now?
Yes, it is okay.
Okay. So if you can give the breakthrough of the slippages, recoveries, and upgrades, and if you could give the latest DPD numbers in the PPD, that will be helpful. So second question, so there was an increase in the credit cost. So any color on that? And for this segment that you cater to, the MSME sector, is 1.5% credit cost the right number, or is it on a slightly on the lower side compared to other banks? Because even the banks that are your co-lending partners, they have credit costs almost 2% or upwards. So any insights on this credit cost piece and why there was an increase in this?
Okay, so the credit cost increased primarily because the disbursals increased. So the way credit costs are done, whatever you disburse newly, you assign a provision which used to be called good book provisioning or standard provisioning. So because our disbursals in this quarter had gone up, that's why the credit cost has gone up. That typically is about 1% of the new business generated. As far as your comparative credit costs are concerned, yes, we are a little lower, and we would like to remain that way because our underwriting is very different than a typical SME lender underwriting. We have been using our SME growth score database underwriting in a very different way. So our estimates are that it will always be little lower than what our peers are.
That's good to hear, sir. So in that case, are BOB or SBI or even central bank, are they increasing their the limits that they want to lend through your platform month on month, or are we still yet to hit the targets that was in the original MOU?
So I will take this question. So at this point of time, whether it is State Bank of India or Central Bank or Bank of Baroda or PSB, the limits allocated are way higher than what we have co-lend with them today. So at this point of time, we do not see any reason why we should go back to even change the limits. We will come to this question maybe about another year down the line or 6-8 months down the line. Having said this, some of the banks that we are doing, we are the largest co-lending partners there. Our co-lending book with the banks is now upwards of 600 crores, and we are seeing more and more demand and more push from these public sector banks to co-lend with them. So At this point of time, we do not have problems with the limits.
Okay, sir. Third, on the provision coverage, so we are at, I think, 30% now. How comfortable are we with this 30%? What has been the recovery that we've been able to do in the recent past? And will this number be settled here, or do you want to take it higher? Because even a CV financier would be at 35-40%. Yeah, I think even other secured guys would be at those levels. So something on this, any insight?
Typically the provision coverage ratios for stage 3 asset keep going up as the vintage of portfolio keeps going up. And it is also should be seen in light of your absolute gross NPAs and net NPAs. So what one wants to balance out is that the uncovered portion of your NPAs should not be very high. So today our net NPA is only about 1.2%, and hence at this point of time we are very comfortable with 30% provision coverage ratio. But as our portfolio matures, as the book size increases, this provision coverage will also keep increasing gradually.
Okay, sir. Thank you. That's it from my side.
Mr. Nikhil Kumar Agarwal, if you can ask a question.
Hello, am I audible?
Yes, Nikhil, you're audible. Please introduce yourself and ask the question.
Hi, good evening. My name is Nikhil Agarwal. I'm from BT Capital. So, sir, first of all, congratulations on the successful set of results. I just had a couple of questions. First, about the FLDG model. So, I just wanted to get a clear view on how FLDG works, because so there was this regulation that banks and NBFCs cannot do FLDG together. So NBFCs and NBFCs have to do together, something like that. So if you could give me a clear view on how FLDG works and how we are doing it in the correct way. So if you could just explain that. And my second question is about credit cost. So you say that with disbursals, the provisions are going up. And although we are comfortable at the 30% level right now, with the increase in vintage of stage 3 assets, our provision will go up. And at the same time, it seems that our credit cost will remain under the current levels of 1.5, 1.6%. So is this going to be true? Because with increasing provisions and the increasing disbursements and AUM targets that we have, I think there could be a further increase in credit costs. So can you please explain these two things to me, sir?
So I'll answer the second question first. When we are talking about the provision coverage ratio, we were talking about the provision coverage on stage 3 assets or NPA assets. And when we are talking about the total credit cost, we are talking about the total credit cost on the overall book. So they are two different things, although they are related in an indirect way, but should not be seen together the way you have interpreted. The more disbursals we do, the stage 1 provision, which is the book which is current, that will keep going up. As our NPAs go up and the vintage of the NPAs within the stage 3 goes up, the provision coverage will keep increasing for stage 3. So these both can exist together. Overall, in our calculation and in our annual plans and for the plans up to 2025, we see that overall, combined both stage 1, stage 2 and stage 3, the credit cost should remain in the vicinity of 1.5, 1.6%. Within this, the stage 3 provision coverage ratio will keep going up.
Sir, just one follow-up regarding this. So I was not confused between the stage 1 provision and stage 2 provision. I just wanted to know that from the incremental provisions flowing through PNL, a major part of it would be for the NPA provisions because vintage would go up. Is that a fair assumption, or please correct me if I'm wrong?
No, so it will be as long as our annual disbursals contribution in the total AUM is higher in the vicinity of, so today, for example, we are at a AUM of 4,400 crore with about 1,300 crore getting disbursed in last quarter itself. which basically means that 25% of the total book has been recently sourced. So this figure will keep going as the portfolio keeps going up. This contribution of freshly sourced portfolio will keep coming down, and that will have an impact. But having said that, the credit cost is also a function of our portfolio construct. We are very clear that 70% of the portfolio will remain secured and 30% will remain unsecured. Now, in unsecured, when it starts getting delinquent and starts moving to stage 3, then the provision coverage on that part increases in an accelerated way. While in secured, we have seen that the recoveries happen and hence one is able to pull it back. So the approach is twin. One is to keep steady on our portfolio design and also keep having a very close monitoring on the contribution of recently sourced portfolio to the overall portfolio.
All right, thank you, sir. And FLDG, please.
I hope that answers your question.
So let me take the first question. And your question on FLDG and is it allowed between the banks and the NBFCs or NBFCs to NBFCs? So we do co-lending and co-lending on two sides of our business. One is with the banks for on the liability side, as we call it. With the banks, the FLDG, there is no FLDG that is allowed. Risk is on a pari passu basis, which means that 20% risk is ours, 80% risk is with the bank. That's one. Two, between the NBFCs to NBFCs, which are both regulated entities, FLDG is what we do as guided by the securitization guidelines, just as a guidance. And so on the asset side, all our fintech partnerships and lending partnerships are regulated entities, and we have a first loss cover from them to an extent as guided by the securitization guidelines. Does a different have I been able to answer the question on what is the difference and with whom are we doing what?
Yes, sir. Yes, sir. I got it. Sir. Thank you. And sir, what is the extent of the FLDG? Is it 10% or is it higher?
So we can take FLDG up to 20% depending upon what product and what kind of. So every partner on the asset side, we have a common lending policy. That's one. And basis the policy, it could range anywhere between 10% to 20%, depending upon the product, geographies, or the way or the operations are evaluated by our risk and credit team.
All right. Thank you so much, sir. That's all. And best of luck for future quarters.
Thank you.
Next question from Mr. Nemin Doshi.
Hello, am I audible?
Yes, you
are. So my question was regarding how is the assignment income recognition different from the co-lending, and how does that co-lending thing flow in our accounts? And secondly, can you just help me with the numbers with regards to co-lending from banks like SBI and BOB, the numbers if it's possible for you?
So I will take this question. So there are two sets of co-lending guidelines. So there is Scheme 1 and Scheme 2. Scheme 1 where you do co-lending on a pari passu basis, where both the counterparties jointly lend to the customer. So if customer is there willing to take 100 rupee loan based on the joint lending program, both the parties will fund in the ratio of the agreement. So if the bank is taking 80% and the NBFC is taking 20%, that is at the stage of origination, both these parties will evaluate the customer, and if the customer they didn't fit on the escrow account, the proportionate fund will move, and from there the disbursement will happen. Here, the accounting would be like a normal lending accounting, where 20% you will recognize the interest, and on the 80% where the bank is funding, the differential interest, if any is there, has to be accounted in the books of the originator. While in Scheme 2, it is more like direct assignment, where you first originate the customer in your book, and then downsell it to the bank or the partner, depending upon the co-lending program and the ratio. So it can be 80-20, which is the most common practice. So in that case, the income is treated like direct assignment, where you have to upfront the lifetime income of that particular loan when converting into the NPV and recognizing your P&L.
Okay, okay, got it. Thanks. And with respect to numbers
And
of
you asking about the numbers on co-lending side. So on this quarter, we have done close to 170 crore of co-lending, which was about 125 crore in the previous quarter.
okay, okay, okay. Thank you.
We'll take the last question due to time constraints, which is on chat. What is the impact of digital lending guidelines on co-lending, both partnership and alliance with banks? Thank you.
To answer, I think first of all, one has to understand the spirit of the guideline. The spirit of the guideline says that the lender cannot be a passive lender, and so should take active part in risk assessment and risk management. So that's one. Two, it also talks about regulated and non-regulated entities. I partially answered this. All our partners on the asset side where we do co-lending and co-origination are regulated entities, which means that where the FLDG now, and that is our opinion, FLDG is not applicable to a partnership between a non-regulated and a regulated entity. We do not have such relationships. All our relationships are regulated, and so FLDG continues to be a part of the agreement. That's one. Two, because these are all regulated entities, all three important, or rather four important parameters that are defined in the guidelines. One is disbursement into the customer account. Two, repayment from the customer directly into an escrow or our own account. Three, the key customer fact sheet, and third, the IT audit. All these have been carried out across all partnerships, and we are compliant across all relationships. So that has not impacted us at all. This does not. It is absolutely similar with the banks that we co-lend with, and so we do not have any impact of the draft digital lending guidelines.
Thank you, ladies and gentlemen. This was the last question due to time constraints. We would like to thank the management of UGRO for taking the time out to address all of us. Thank you on behalf of Anand Rathi Institutional Equities.
Thank you.
Thank you, everyone. Thank you, everyone. Thanks, Ketal, for organizing this.
A pleasure. Thank you.
Thank you.